What could be easier than buying time when it's cheap and selling it when it's expensive? It sounds like the ultimate trading rule, but in the options market, this exact logic is a psychological trap. When you buy a cheap contract, you aren't buying a discount. You are buying pure time value. It is the mathematical premium of uncertainty, the price tag placed on the volatile space between today and expiration. It doesn't care about your support levels or your technical analysis. Time value exists for one sole purpose: to evaporate, transferring wealth from those who buy hope to those who sell reality. Let's look at the math behind a real asset. Imagine Coca-Cola trading at exactly $80. If you look at calls, a 75 strike call is in the money. It costs $6. Because you can buy Coca-Cola at 75 when it's worth 80, it has $5 of real cash value. That's your intrinsic value. The remaining $1 is pure time value. But this exact matrix applies to puts when you short the market. If you buy an 85 strike put, you are in the money. Why? Because you have the right to sell Coca-Cola at 85 when the market is at 80. If that put costs $6, it holds $5 of intrinsic value. The extra $1 is the time value you pay for the remaining days on the calendar. The real trap for both calls and puts lies in the out-of-the-money strikes. A 75 strike put or an 85 strike call might look like a bargain at 20 cents, but neither holds a single penny of real intrinsic cash. That 20 cents is 100% time value. If Coca-Cola stays flat at $80, those premiums don't just decay, they vanish. Whether you are betting the market goes up or down, if you buy pure time value, you are paying a premium just to watch the clock run out. Even veteran traders get blindsided by how time value behaves because they treat it as a static variable tied strictly to the calendar. But time value is highly elastic. It is the literal pricing of implied volatility. When uncertainty peaks, the time value component expands, artificially inflating the premium. If you buy contracts here, you are overpaying for risk. The moment volatility contracts, that time value collapses instantly, not because days passed, but because the market repriced the premium of uncertainty. The master trader doesn't just pay for time value, they weaponize it. Instead of buying inflated uncertainty, you align the mechanics. You look at delta to define your probability, and you let theta decay dissolve that overpriced premium day by day. You stop financing the market's pricing errors. You stack the Greeks in your favor, and you let the clock do the heavy lifting for you. In the options market, price direction is merely a chaotic variable, but the ultimate liquidation of time value is a mathematical certainty. At expiration, the illusion dissolves. The premium of uncertainty returns to absolute zero.